All right, so let's talk a little bit about the pros and the cons of new construction. So the things I love about new construction, first, it's going to come with a builder's warranty. So all of the teams are offering some level of warranty. There's a little bit of variation from team to team. And just to upfront say, you're going to hear that phrase a lot. There are variations. I couldn't make one presentation that covered all of the nuances of all of the different teams and all the properties they offer. So know that there are some variability between the teams, but all do offer some builder's warranty. They usually cover the main components in the interior of the home, so all your appliances for the first year, some of them 2 years. And then there's usually a 10-year warranty on the structure. So if you have foundation issues or something, that's covered by the builder's warranty too. The new construction homes are built in compliance with the latest construction codes and standards. So this usually means that these homes are cheaper to insure. They're certainly cheaper to insure than the 100-year-old Craftsman. Those can be very pricey to insure. And then also when you're looking at weather threats. So say, Florida kind of concerns you because of hurricanes or the risk of, strong winds. Well, these new homes are built with, the latest technology in hurricane ties and hip roofing and things that are all making them, I think, the best to weather that kind of weather, certainly than an older home. And then everything is new. All the paint's new, all the windows are new. So this is going to mean less maintenance for you as an investor, certainly for the first few years of ownership. And then because this home is shiny and beautiful, they tend to be more desirable to tenants as well. So this could potentially reduce your vacancy as well. They can lease up a little bit quicker. And most of our teams are saying that the tenants who rent these new construction homes, they tend to stay a little bit longer too. You can usually get 2, sometimes 3 years out of them to stay. More pros of new construction. I already kind of mentioned this. These are often in fast growing areas, which means that there is oftentimes a greater likelihood of rapid appreciation. So I love that idea. It could be easy to sell this home in 10 to 15 years because in 10 to 15 years, it's still pretty good looking newer house. And you're more likely to be able to sell it for a good profit just based on that short-term appreciation. Now, you're going to hear the phrase infill lots pretty frequently. And for those of you who are kind of new to this concept, what is an infill lot? An infill lot is an existing neighborhood. It's an established neighborhood where there was a vacant lot. And so the builder or the developer acquired that lot, and they're building a new construction home in that already established neighborhood. So the benefit of the infill lots is that they're largely in owner-occupied neighborhoods. It's not, and this is where I want to draw the clear distinction, because I think a lot of the headline news, at least some of the headline news that I've seen where they talk about this new construction rental product, they are oftentimes referring to a whole neighborhood of nothing but rent houses. So they're all new, but they're all rentals. And sometimes you hear this called a horizontal apartment complex. Sometimes the whole development is owned by one big investor and managed by their kind of on-site property management company. That's not what we're getting into. These are infill lots. So you're going to be that one brand new house that's plopped in to that already established neighborhood that are oftentimes largely owner-occupied. And then often there are frequent tax advantages during the first year. So in most markets, your taxes are assessed in the rears. So they're looking at the previous year, a value of that home. And at that point, it was just a lot. So oftentimes you see a huge tax benefit, particularly in states like Texas that do have higher property taxes going forward. You see some savings in that first year, depending on when you acquire it. And I think it's a particularly great strategy for Texas when you think about potentially a shorter term hold. I know some of our teams there really do believe in this shorter, maybe 5 to 7 year hold on a property. And the cash flow, once the property taxes are reassessed at the actual value of the home, they can go up pretty high. And so you look at that pro forma, that projection of what the taxes will be, and it can be kind of deflating. So it's like, oh, it's only $200. That's not great. But if you're only planning on keeping a house for 5 to 7 years and your first year of owning it, your taxes were only based on the land value, that's a substantial difference oftentimes. So you think about that savings prorated over that 5 to 7 year period of holding it, sometimes it's not that bad. So just be sure that you're looking at it holistically and certainly considering those tax advantages as well. All right, let's get to some of the downsides, because I think there are some things to consider, some cons of new construction. The first is most of the homes that our teams are selling are pre-construction, meaning they haven't been built yet. So sometimes they don't even have the permits for them, or they don't have all of the permits for them. So depending on where that home is in process, it could take some time for that home to be completed. This certainly makes the new construction product not always a viable option for 1031 exchanges, because we know that when you're a 1031 exchange investor, you have a tight timeline. You have to close on your replacement properties 180 days from the closing date of the relinquished property. Depending on the home that you're putting under contract, you need to make certain that not only is it projected to be completed within that 180-day window, but you want to give yourself some extra time on the back end too, because we all know, even if you've never bought new construction, you have a friend who has, we all know that new construction runs long. And very frequently your timeline is delayed because of weather, or like we talked about earlier, supply issues. So that is a downside. It's just not always a viable option for 1031 exchanges, though I will say some of our teams can accommodate the 1031 exchange. They're going to have a come to Jesus kind of reality talk with you up front about properties that they know just probably won't really work, but some are reserving some properties for those 1031 buyers. So don't rule it out just because you're a 1031 client, but understand the risk. There is a little bit of a premium for new construction. I tell everybody you can't have your cake and eat it too in life, and you can't do it in real estate investing too, or either. You are paying a little bit more, but that's because you're getting the low maintenance property. You're getting a property that rents quicker. So you're paying a premium to have that brand new product. And then new developments. So some of the teams, particularly like the Atlanta team, they are building in new housing developments. So in contrast to the infill lot, these are brand new developments where every home in that development is brand new. Again, they're largely owner occupied. The builder's not selling just exclusively to renters. They're selling a small portion of those properties to investors. The downside, or I think the thing you got to be cautious about the new development, is that they might not be established. I had a personal experience with this. I bought a brand new construction townhome, and I only the first half of it had been built when I purchased it. I lived in this one. This was a former primary residence, and lived in it for a couple years, lived in it for about a year, moved out, and then the developer fell on hard times, and he wanted to sell the development. He couldn't sell the last couple ones that he had available, and so he started dropping the prices on the homes. And I watched my property value. We did a refinance during that time, so I have an appraisal during that time period, and I mean the value of my property went down about $5,000 to $7,000 just in the 2 years that I held it, which is disappointing. But again, if you watched my webinar the other day, I talked about property values, that it's totally unrealized gain until you actually sell it. So of course I didn't sell it during that time. I just knew, oh, I got to hang tight now because I got to dig myself out of a little bit of a hole. And so it took a little while to kind of get the development. It got purchased by a new builder, and things over time were built and bought, and so now property values are back up where they were. But if I had a short-term strategy to get in and out of a market, in a 5 to 7 year period to capture some appreciation, and that happened, that would be devastating. That would be upsetting, right? That wouldn't have gone the way I wanted it. So just keep that in mind when you're buying in a new development. You want to have a really good understanding of the security of the builder, the completion, the estimated completion date of the entire development, and keep an eye on comps, certainly. But a lot of those new developments, the builders are extremely experienced and extremely cautious about their pricing and making sure that they're keeping up with those growing building costs and with the demand to keep everybody kind of on this growth trajectory. Infill lots do require careful due diligence. You do want to be really careful, I think, in your lot selection. You are getting plopped into an existing neighborhood, and the general real estate guidance that I know you've all heard is that you want to own the worst house in the best neighborhood, not the best house in the worst neighborhood. That usually doesn't do great things for appreciation or property values. So you got to be really careful with it, you know, and make sure that you understand kind of the growth and the development of it, and understand just the rents that that property can command in that particular area. But our teams are all pretty well, they pretty well understand the growth and select these lots just based on knowing that they meet that investor's criteria. Rent to value ratios are often a little bit lower with new construction. So the 1% rule that some investors use as a litmus test, that is not, I think, a really viable litmus test for new construction. Those rent to value ratios are definitely going to be lower than 1%. So this translates to less cash flow initially. But again, we know that if we're in a growth market, it's likely that those rent prices are going to go up over time. And so our cash flow should grow as well.